Bitcoin dropped to $89,000 and suddenly everyone's an expert calling for a bear market. Meanwhile, whales just stacked 1,384 wallets holding over 1,000 BTC. That's the highest level in 4 months. El Salvador dropped another $100 million. Global M2 money supply sitting at $137 trillion. The people screaming bear market are looking at price candles while completely ignoring the biggest liquidity injection we have seen in years. Today I'm breaking down the actual data, the macro signals, the on-chain movements, the institutional plays. Everything that shows Bitcoin is loading up for its next move, not rolling over into an extended bear market. And it starts with the biggest lie everyone still believes about the Bitcoin cycles. This is not financial advice, always do your own research. The first chart I'm going to show you is from BTC Therapist. He drops a truth bomb that most people still haven't processed. There was never a 4-year cycle in Bitcoin. It was the underlying business cycle. Everyone thinks Bitcoin magically moves because of halving. Like halving is some magical financial ritual. But look at the PMI chart he shared. The Purchasing Managers Index is a leading indicator of whether the economy is expanding or contracting. And guess what? We've been in contraction since 2023. Historically, when PMI reverses from contraction back into expansion, risk assets, especially scarce risk assets like Bitcoin, explode upward. Every major Bitcoin rally lines up with PMI recovering. As we can see at the last 2 halvings, the PMI cycle was growing and so did Bitcoin. And right now, PMI is curling off the bottom. That's the moment when smart money positions early. Retail is always late because retail always waits for prices to pump before they feel safe. To further solidify the macro connection, we'll look at the powerful correlation between Bitcoin and the classic macro indicator, copper to gold ratio. Copper is a key industrial metal. Rising copper prices signal industrial demand and economic growth. Gold is the traditional safe haven. The ratio is a pure reflection of market risk appetite. When the copper to gold ratio is trending up, it's a global risk on signal. When it is trending down, it's a flight for safety or risk off. So right now the copper to gold ratio, as we can see, is hitting the support zone, and the next thing is the move to the upside in combination with the PMI. The most compelling argument that the bottom is either in or extremely close can be found, however, in a simple reading of human psychology. We're talking about the Crypto Fear and Greed Index. The index is designed to prevent emotional overreactions built on the principle that extreme fear can be a buying opportunity and extreme greed means the market is due for a correction. Right now, it is at an extreme fear. And as we can see, in the previous 2 times the market hit extreme fear, that was a very good buy signal. This time could be no different as well. Perhaps the single strongest argument against a bear market is the following: the unprecedented wave of global liquidity and monetary easing. The entire world's central banks and governments are injecting capital into the system at a scale that dwarfs previous cycles, and Bitcoin is the ultimate beneficiary. The Kabaisi letter summarized the current global situation perfectly with these macro tailwinds. The US is preparing $2,000 stimulus checks. Japan is preparing a $110 billion stimulus package. China already has approved their massive $1.4 trillion stimulus package. Remarkably, the Fed is officially ending quantitative tightening on December 1st. Canada's going further and is restarting its quantitative easing program. But the most critical data point among these is the money supply. Global M2 money supply is at a record $137 trillion. Money supply expansion is the primary driver of hard asset appreciation. The correlation between the M2 money supply and Bitcoin's price has been shown to be incredibly strong. Although right now, with this drop, it has decoupled a bit. When central banks flood the system with liquidity, that money inevitably flows out of depreciating fiat currency into scarce assets. Bitcoin, with its perfectly verifiable scarcity and decentralized nature, is the final destination for this tidal wave of new money. The money printer is going to run hotter than ever before, and the floodgates are about to open for risk-on assets. A bear market cannot survive in an environment of unlimited liquidity and fiscal stimulus. Remember that. Now we combine the macro liquidity with the on-chain data to confirm where the money is flowing. This is the great wealth transfer from the weakest hands to the strongest. First, let's look at the large players. The Cointelegraph whale alert confirms the action. The report shows that whales are buying the dip as small holders offload. Wallets holding over 1,000 BTC jumped to almost 1,400, the highest level in 4 months. This is institutional and large cap accumulation. They see the short-term dip not as a warning, but as a window of opportunity to acquire a scarce asset before the macro liquidity wave hits. This is further validated by the crypto quant analysis. The headline is the thesis. Long-term capital is stepping in aggressively while short-term sentiment is capitulating. The chart shows a massive spike in permanent holder demand change. These are the investors who have successfully weathered every market cycle and are known for holding Bitcoin for years. They are not selling. They are buying the fire sale created by the short-term holders. Finally, we look at the sovereign level. The decision by El Salvador to buy the dip is the exclamation point on this entire thesis. They bought 1,098 Bitcoins worth $100 million. Their action once again validates Bitcoin as a strategic state-level reserve asset. Bukele and co. are acting like the ultimate permanent holder, choosing to acquire Bitcoin during a period of fear and price weakness. When you put it all together, that's massive whale accumulation, historic long-term buying, and a sovereign nation increasing its treasury holdings. All while the weakest hands are selling at a loss. As you can see on this chart, the paper hands have capitulated, hitting the lowest level. So, you realize the structure of the market is being reset for a major upward move. This is a supply shock being engineered by the strongest capital on the planet. Additionally, as we stand at this point of maximum fear and on-chain capitulation, we must remember that the market is nowhere near its peak. According to CoinGlass's bull market peak indicators, none of the 30 major top signals have flashed yet. We are at a mid-cycle consolidation, not a cycle top. The structural bull case remains entirely intact. Bitcoin ultimately is not falling into a bear market. Not while liquidity, macro, and nations themselves are lining up behind it. The bears are staring at price candles while ignoring the biggest monetary shift happening in years. The evidence is right in front of you. The liquidity cycle is turning, and Bitcoin is preparing for its next move up. And now, if you want more breakdowns like this, make sure to follow, like this video, and share it with someone who still thinks Bitcoin is going back to 20k, because they need help. I'm Stan, this is airdrops.com. Thank you for watching. See you next time.